Well, welcome to the first Flash Talk. I promise we're going to shift gears here and be slightly more optimistic about the markets and the opportunities set here today. But I'm Brett Graffy. I'm joined by my colleague, Chad Sheaffer. We're members of the Marquette research team. We cover private markets as well as hedge fund research. And the purposes for our discussion today is going to be fixed income alternatives, delivering return in an uncertain environment. So my colleagues have done a great job highlighting the risks and opportunities that exist in the marketplace today. They've done a tremendous job laying out just how much the market has changed in the past 12 months, even the past 9 months. One of the areas that's changed significantly is fixed income, and that is evident by the fact that the U.S. aggregate bond index is down over 11% on the year, making its worst year on record going back to 1977. Additionally, the traditional 60-40 portfolio, that's having its worst year since 1932. And even though there are those challenges in the marketplace, in particular fixed income, we think there are opportunities in the fixed income market today. We're going to be discussing those two opportunities, which are private credit and structured credit. We believe these two asset classes present investors with strong diversification benefits, as well as the opportunity for outsized gains in a fixed income market that is likely to look very different than it has the past 30 or 40 years.
So let's just set the stage here a bit. My esteemed colleagues on the Investor Roadmap Talk discussed a lot of things that are affecting investor portfolios so far this year. The worst year on record for fixed income, generational inflation, an aggressive Fed rate hiking cycle. So I promise I won't belabor those points anymore. What I do want to touch on is on the left-hand side of this chart. The yellow line represents the 10-year interest rate for 10-year treasuries. As you can see, up until recently, rates have been on a one-way path lower, and that's been a sustained tailwind for fixed income portfolios. At the same time, corporate issuers have taken advantage of these low rates, extending out financing on their balance sheet and locking in those low yields. In fact, interest rate sensitivity, measured by the blue line here, is at the highest level it's ever been, more than 40% compared to the financial crisis. While I agree with my colleague Frank that duration is important in a portfolio, creates ballast, there are other alternatives out there to consider that can complement and add value to portfolios, and we'll talk about a few of those today. First, we'll start with Brett talking about private credit.
So private credit. So if you've read the Financial Times or Institutional Investor, you've probably read that the asset class is a growing and emerging asset class. Well, that is kind of true. Private credit's really existed for decades. The biggest difference is the past 10 or so years is that the asset class has been dominated by non-bank institutions or money managers, where prior to the great financial crisis, this area of the market was still controlled by the banks. And we'll go into that paradigm shift here shortly. But as you look at the chart on the left here, as you can see, the private credit market is about $1.2 trillion market today. It's almost on par with the levered loan market. The majority of that growth has really come in the past 10 or so years. Additionally, private credit's a blanket term that can take many different sub-asset classes, such as distressed debt, special situations, venture debt. For the purposes of today's discussion, we're going to be talking about direct lending. And what I mean by direct lending is really a middle market or lower middle market business receiving a binary loan from a non-bank institution. There's not too much more complicated beyond that, but we'll talk about some of the features and terms of those loans that make them particularly attractive in this environment. So most of everyone here is familiar with the syndicated loan market, often referred to as the levered loan market. Chances are you probably have an allocation to the asset class. Where we think the big difference is in the opportunity set for both middle market direct lending, but then also syndicated loans. So syndicated loans are the loans to the largest businesses in the US. The SBA defines these large cap businesses of having $1 billion or more in revenue and employing more than 500 employees. By that definition, there's about 20,000 of those companies in the US that fit that. Take a step function below and focus on that small and medium-sized businesses. There are 32 million of those businesses in the US today. That's an opportunity set that is 1,600 times larger. Additionally, those middle market and lower middle market businesses, they account for 98% of all businesses in the US. They employ 50% of the US private sector workforce, and they account for 32% of the US export value. In addition to the opportunity set being bigger, I talked about the terms and features that we like in the asset class. First is the premium, and the premium is the premium at origination. So typically, private credit direct lending gets about a couple hundred basis point premium yield above syndicated or levered loans, like I said, at origination. Additionally, we like the fee structure. Compared to other alternatives like private equity and venture, that's a 2 and 20 fee structure, private credit is closer to a 1 and 10. And then finally, we like the fact that it is floating rate that adjusts on a quarterly basis based off of LIBOR or now SOFR rates. That is particularly advantageous in a rising rate environment. We'll get into more than that shortly. But let's talk about what's created this paradigm shift. So Thomas Paine said about the banks that they're a pawn shop for promises. And for most of the 17th, 18th, and 19th century, that's exactly how the banks function. The biggest difference has come in the past 10 or 15 years, where the banks are very, very structurally different than they were back then. Additionally, from 2010 and 2013, there were 0 bank charters issued in the US, which only exacerbated a long-term trend that you can see in the graph on the left from the early 2000s, whereas today we stand at about 4,500 total banks in the US. That's not bank locations, that's just total banks. That number has been cut in half since the early 2000s. Additionally, post-GFC, there were increased regulations on the banks, such as Dodd-Frank, and then also capital constraints on the bank. Maybe the biggest change to bank lending practices came in 2013 from the Office of the Comptroller of Currency, a directive on leveraged lending practices that stated that banks should not lend to individual businesses beyond a 4-to-1 total debt to EBITDA ratio. This strictly limited or stymied the bank's ability to take risk and lend to those small businesses. And to fill that void, entered the non-bank institutions or money managers who became the financiers of choice of those 32 million businesses in the US today. Let's talk about performance. And I think it's most important to talk about downside performance just given the market environment we're in today. So Moody's conducted a study several years ago looking at the factors that cause bankruptcies or defaults. And what they found was that the number one factor for bankruptcy or default for an individual business, about 30 or 40% of the time, was the amount of leverage or debt at the company level. And then they took it a step further and looked at the amount of leverage or debt at the company level by company size. So they looked at lower middle market businesses, core middle market businesses, upper middle, those large cap businesses. And what they found was that those large cap businesses tended to have way more debt at the company level compared to their small and mid cap or small and medium sized brethren. And how that comes out in the data is that direct lending or private credit loans tend to have lower default rates, higher recovery rates, and lower overall loss rates. Now you're probably saying, that's great, that's wonderful, but that's backwards looking data, and that does not take into account the fact we're in a rising rate or inflationary environment. That being said, there have been 3 instances in the past 10 years where over a prolonged period of time, interest rates rose by 75 basis points or more. In all 3 of those instances, if you look at private credit performance, private credit was up almost double digits during all 3 of those time periods. Alternatively, looking at investment grade bonds, they were negative all those time periods. And that is a product of the floating rate nature of these securities, the fact that they adjust on a quarterly basis based off of LIBOR or SOFR. And you extrapolate that data further and take it over a 15-year period, you can look at the correlations. You see a strong negative correlation between private credit and investment grade bonds. This only strengthens or at least hammers home the idea that the asset class is a strong complement to an existing fixed income portfolio and a strong diversifier to an overall portfolio. In pivoting about another asset class that we like in private credit is alternative credit. So similarly, alternative credit is a blanket term that takes a number of different sub-asset classes. It can mean aviation finance, litigation finance, FinCo financing. But for the same reasons that we like direct lending, we like alternative credit. The fact that the asset class is a strong diversifier and also involves idiosyncratic assets that tend to zig when other assets zag, which is why I'll turn it over to Chad to discuss the opportunity in structured credit.
Perfect. Thanks, Brett. So now, turning to structured credit, what do I actually mean when I say structured credit? Put simply, these are pools of similar cash flowing assets that are combined together. Then through a securitization process, these are the priority and the distribution of those cash flows are then tranched out, each with their own risk return profile. As you can probably tell by the collage here on the slide, there are many different underlying assets here. These can be mortgages, office buildings, student loans, credit card receivables, even more esoteric things like shipping containers, aircraft leases, rail cars. All of those can be brought together, securitized, and then tranched out. The point being here, these are very large, very diverse markets with many different risk-return profiles for investors to choose from when building an allocation. Now, you may hear that term structured credit again and think back to the financial crisis, thinking of some of the excess risk-taking that happened during that period. And it is true, parts of the structured credit market did create some of the catalysts that formed the financial crisis and ultimately the losses that we faced as investors. But what I can tell you today, things are much different than they were back then. Regulation primarily, the Dodd-Frank Act, has significantly altered the disclosures and reporting that has gone into structured credit, meaning that there's better transparency, investors know what they own, they actually understand what's in their portfolios. The rating agencies, which came under fire during the crisis, are significantly reformed and underwriting standards are far better today than they ever were in the past. And perhaps most importantly, the originators of structured credit, they need to keep skin in the game at this point. They own exposure to the tranches of these securities that they create, and therefore that helps to avoid some of that excessive risk-taking. Again, they have their own capital at risk. Turning to some of the benefits of structured credit, what really matters here? Of course, there's also risks. There's no free lunch in investing, so I'll touch on those as well. But first, for the positives. I touched on interest rate sensitivity earlier. Brett talked about private credit and being floating rate. The good news here, these are also floating rate. When rates rise, these securities stand to benefit through higher yields as part of that resetting process in these securities. These are also very large, mature markets. Through the tranching process, there's also varying risk-return profiles to choose from. All of that combines together for flexibility in portfolio construction. These also tend to be higher yielding relative to traditional fixed income. Again, another benefit in portfolios. Now turning to some of the risks. There's no doubt structured credit is more complex than, say, traditional fixed income investment-grade corporate bonds. Additionally, when markets are in stress and there's a significant sell-off, fundamentals tend to go out the window. Structured credit is no different. They suffer from some of those similar challenges where that doesn't really matter and they get purged from portfolios. That leads to higher mark-to-market price volatility and increased correlations at times when it really matters. This is not dissimilar from other asset classes as well. The key here, though, is that manager selection really matters. Managers that can be conservative and protect in some of those areas of difficult performance can be on a position to play offense and take advantage, ultimately leading to attractive returns if you can stick with the volatility. Now, I touched on some of the performance, some of the volatility. How has structured credit actually performed? If you look at the blue circle on this slide, you can see a number of different types of structured credit products manager performance. These are median manager performance over the trailing 10-year period, and it's compared to other types of just traditional fixed income, high yield, the US aggregate index, investment grade, so on and so forth. In almost every case, structured credit has provided significantly superior absolute and relative returns on a risk-adjusted basis. Turning to the right side, another benefit to the portfolio construction process, these assets have tended to be diversifying to other areas of your portfolios. In particular, I'll call out the US aggregate, again, a proxy for investment-grade fixed income in your portfolio. Over the trailing 10-year period, the correlation between those two assets has been really zero, highlighting, again, the diversification benefit and the additive purpose for having structured credit in a portfolio. Now, maybe just pivoting a little, I thought I'd try to highlight that securitization process. How does it work? What does it actually look like? To do so, I thought I'd look at a specific type of structured credit, in this case, CLOs. So what are actually CLOs? What do they do? CLOs invest in what's called leveraged loans. These are senior secured floating rate bonds from high yield corporate issuers. CLOs then take those senior bonds, again, that are top of the capital structure in their own corporate capital structure, combines them together, and then again, through that tranching and securitization process, creates different tranches, each with their own risk return profile, their own priority to cash flows, and ultimately, each of those tranches are rated. As you might expect, at the senior parts of the capital structure, AAA, AA, single A tranches, these are the safest parts of the structure. They have downside protection in the subordinated tranches below them. They have the first priority to cash flow claims. As you also might expect, they're also the lowest expected return part of this tranche. As you move down the tranche structure, the risk certainly increases. You're more likely to face losses in a very adverse environment, but so does the expected return. It increases, it improves, and you're compensated for that risk. Now, active managers can play a really important role here. They can move around in those different tranche structures. They can select different attributes and characteristics in portfolio construction and ultimately build an attractive return profile, again, navigating these complexities in the tranching structure. Now, again, let's look at performance for CLOs specifically here and how have they done versus traditional fixed income. Across all of these tranches, across all of these rated debt structures, CLOs have provided superior returns over the last 10-year period. There's a couple of reasons for this. Again, I touched on the securitization process, the higher coupons that these securities tend to have. That's one thing. Again, they're floating rate. They benefit in an environment like today. But most importantly, that securitization process creates added downside protection. In fact, so much so that every one of these tranches across those different ratings have had lower default experiences relative to corporate bonds and high yield. Even leveraged loans that go into these, again, the defaults have been lower. AAA and AA tranches have never experienced a permanent impairment over the inception of CLOs, which is a pretty remarkable stat, just highlighting how the securitization process can provide that protection for you. Now we're in a tough environment. Let's look at some of the drawdowns over time and what has happened. There's no doubt there will be volatility in structured credit like many other asset classes, but for investors that can be patient and navigate those ups and downs, the recovery on the other side tends to be relatively attractive, actually really attractive. If you just look at averages over the past few drawdowns all the way back to 1992, you can see that the average drawdown is somewhere around 10% or so. But over the next 12 months, that recovery more than doubles that loss, and investors are rewarded for staying patient and sticking with the asset class. The drawdown this year has been relatively modest, down 5% or so, nothing too aggressive compared to equities or even traditional fixed income. And same thing as these other drawdown periods, we've seen a partial recovery. About 60% of those losses have already been recovered. So again, there's volatility, you can't avoid it. Manager selection can help navigate this, play defense in those dislocation periods, and then play offense to then add and take advantage of those returns on the other side. So bringing this all together, what are the key takeaways? What really matters here? Alternatives to traditional fixed income, private credit, structured credit, alternative credit can play a key role in portfolio diversification, adding attractive returns, but also providing that downside protection in periods of uncertainty. I touched on some of the benefits of structured credit, opportunities such as attractive yields. They benefit from this rising rates structure. They're floating rate, but they also benefit in periods like we're facing today, but also that downside protection, which is paramount to this asset class.
Thanks, Chad. And just to reiterate, if we didn't make it clear, it's clear we like private credit. We think in this market environment, it makes sense to be senior, top of the capital structure, senior secured, and really an uncertain environment that includes rising rates and inflation. Also, we hope at least we laid out the opportunity set for this market. We believe this market has plenty of room to grow given the $2.5 trillion now sitting on the sidelines waiting to be invested on behalf of private equity, but also the fact that the banks have left this market for the most part and it's been filled by non-bank institutions. And then finally, with the backdrop of all the challenges we are facing, we think it is important that manager selection is paramount and more important than ever. For those reasons, we focus on managers who have robust sourcing pipelines, have the ability to prudently and efficiently deploy capital, but then also work out more challenged investments that lead to beneficial outcomes for investors. So thank you very much for your time. Thank you very much for the opportunity. Chad and I will be around the room mingling. Even though we're millennials, we like to make friends. But I'll pass it on to Lindsay and Ibrahim to talk about ESG. Thank you.